Pandemic happened, government came in, printed trillions of dollars, and that, in my mind, postponed the recession today, which I believe we're finally going to come up on the recession.
What is happening, Best Ever community? This is Matt Faircloth, and I am your brand new host for the Best Ever CRE Show. Guys, Jeremy Roll has been a passive investor for many years. You guys might have heard of him, of course, and we're going to get into a great conversation about passive investing today. So, Jeremy, welcome to the Best Ever Show.
Thank you. Thanks for having me on. Thanks everyone for joining, and hopefully this is just helpful for everybody.
Yeah, I hope so. And Best Ever listeners, I want you guys to listen to this from a perspective of perhaps a passive investor, if you are a passive investor. But if you're a syndicator operator like myself, look at this as a perspective of you hearing the perspective of the world from someone that you are hopefully trying to enroll into one of your deals. So this is really enabling you to turn the tables to hear the mindset and the way that a passive investor looks at the world. So I'm really excited for this conversation. So Jeremy, to get going, how did you get into passive investing to begin with? Like, how did all this begin for you?
Yeah, I know. Absolutely. So this is a long time ago now. So I've been passive investing for over 22 years. So I started in a whole different era without smartphones, et cetera. But it was back in 2002. And essentially, I was working at Disney headquarters in Burbank in Los Angeles. And I was really bummed out, honestly, by the dot-com crash. Because I was investing in the stock market and in bonds like traditional investor and my Fidelity 401k plan with Disney and all this. And the lack of predictability and the volatility of the stock market was not a good fit for my personality, for my long-term retirement, not knowing where things would be in 10, 20, 30, 40 years, just wasn't the right fit for me. So I started to look at different ways to invest, solve that predictability problem. And I came across the concept of more predictable cash flow as a possible solution. And then I focused in on real estate, and I started basically dabbling into passive syndicated opportunities back in 2002. And then it just unfolded from there.
That's cool. And it just grew on top of it. I know operators that you've invested with and familiar. I know you to be very a savvy passive investor and everything like that. And so all good stuff. So you've grown into a very in all kinds of diverse asset classes and everything, real estate too. But you told me offline that you're involved in other stuff outside of real estate, which is a good thing to do. You should invest in all one thing, of course, guys. Fast forwarding to not even today, but the last couple of years ago, the real estate world has changed. I felt like I went to bed one night and everything was hunky-dory, and I woke up the next morning and we're standing in the middle of a tornado here in real estate, right? And a lot of that's to do with drastic overnight changes in the economy, and also what felt like overnight changes in interest rates. Not really. Obviously, it changed over a period of time, but real estate has changed a bit. Can you tell me what that's been like as a passive investor, going from like the 2018, 2019, then pandemic, that changed a lot of things in our industry. And then post-pandemic world, since 2022, we've seen drastic changes in real estate and interest rates. What's it been like from your perspective as a passive investor?
Yeah, it's been quite a ride, and for so many reasons. And I don't need to tell anybody that who's been through the pandemic. Everyone who's with me today has been through a pandemic. And so honestly, almost the best way I could describe it, I feel like I was in two different cycles in just a few years. And I'll explain what I mean. So I was being very defensive as an investor as of 2017. I personally felt like everything was overpriced and very expensive as of that timing. And I was really lobbying, which doesn't really do me that much good as a single passive investor.
Hey guys, hope you're loving this free education here on our YouTube channel. And if you guys love free stuff, I got more free stuff for you. Go to DeRosaGroup.com/tools, and you will see a bunch of free stuff that we've got out there. Everything from a superpower assessment to determine what your multifamily superpower is, all the way down to a free book on how to buy and find apartment buildings for you guys, even a free underwriting tool. It's all there. Go to DeRosaGroup.com/tools and grab some more free stuff. Grab that link down below and let's head back to some free education on our YouTube channel.
So I was really pushing my sponsors, lobbying my sponsors to try to sell in 2017 through 2020 because I was anticipating a downturn. And the challenge is that because I look at a longer term timeline, I try to get into a 10-year fixed rate loan very commonly because of that predictable focus that I have to think way ahead. I can't just think a year or two ahead. So I think years ahead when I can. And so I sat around between 2017 and 20, hoping that things would sell, thinking it was the end of a cycle, thinking that was the exact right thing to do from a cycle timing perspective. I was extremely careful on the investing side and did a lower volume of investing than normal because of my concern over recession. Then, of course, the government came in, pandemic happened, government came in, printed trillions of dollars. And that, in my mind, postponed the recession that most likely was going to happen, more from a probability perspective, was most probably going to happen at that point. And so essentially, I've been sitting on the sidelines since 2017. It's been a very long time. And I've been very defensive for many years now. And it's funny because even today, which I believe we're finally going to come up on the recession that I think has been postponed, we could talk about. Even today, I was literally yesterday telling somebody that this appears to be a good time to sell because we haven't had the recession yet. We haven't had a stock market crash yet. And I'm actually in a few mobile home parks in a fund that are selling. I'm actually happy about the timing, which I know sounds odd to some people. But I just see liquidity being much more constrained in the next 6 to 12 months than it is today. So I know we touched upon a lot of stuff there.
No, that's good. But I got like a very basic. So you haven't initiated a new passive investment since you said 2017, 18.
No, I'm always investing, but my volume is much lower than normal. So it'll be much higher at the beginning of a cycle and much lower at the end of a cycle. And the specific things I'm investing at the end of the cycle, I believe will do well during an economic downturn and or are unique because I'm at the end of a cycle. One of the biggest challenges for me is negative leverage and also very high pricing. And the only way
it sounds like it's your belief that we're getting towards the end of a cycle, and that's an interesting concept that we're supposed to have a recession in 2020. And I had heard that before too, and that's that we were due. It's just the metrics are starting to point that way. And then COVID happened, and all bets are off, right? And so the government goes and prints $4 trillion or so at that time, and then injects it into the economy. And that you could argue that's why real estate bumped, and that's why a lot of things did what it did. But now, time to pay the piper. Maybe it's come back around. If folks subscribe to that psychology that we're at the end of the cycle that we're in, which has been a heck of a ride. It's been like 15 years.
A record long cycle. Record long.
What's that?
That's a record long cycle we've had. So eventually it's going to end.
What are the asset classes that someone looking to invest now, I've put my passive investor hat on, right? What asset classes should people be looking in at the end of a cycle, perhaps going into a dip? What's most exciting right now that maybe might weather that storm and maybe bump up when we recover?
Yeah, I'm going to answer that question, but I'm also going to say I have a second part to that answer that's important to consider too. So my answer to that question is there are certain asset classes that do better than others during recessions. And actually, even within certain asset classes, mobile home parks tend to do well in a recession because they're one of the lowest cost housing that you can find. Okay, so they're not immune. Nothing's immune to a recession, to be clear, but they may hold better as far as occupancy and et cetera than some other asset classes, right? Retail strip center. If you have a retail strip center that is anchored by a grocery store, a pharmacy, and I don't know, Pizza Hut, right? And maybe some other things, and a gym, let's say, that's probably going to do okay during a recession. Your cash flow is probably going to come in. Your leases are probably going to be paid. But if you're in a retail strip center with a huge furniture superstore, right? And some other things that are much more susceptible to a recession where people don't necessarily have to do that type of spending, hardware store, for example, those will be much more susceptible to recession. And so even within certain asset classes, you have to really look at the tenant base and sometimes just the location. Some locations are less susceptible to recession than others. And I can use an easy example, Las Vegas, which is tourist-based. If you have some properties near the Strip, that tends to be very cyclical with the economic cycle. And that could be more prone to having a problem during the recession than a lot of other locations. But I want to say this, though, and this is the second thing I want to mention. So let's pretend, because we're recording this in August of 2024. Let's pretend we're recording this in August of 2007, around that cycle timing, okay? I'm not saying everybody get your like 2007, 2008 hat on in terms of what's going on in real estate, just cycle timing. And you say to me, what's good to invest in right now, right? That will do well in a recession, will do well. My answer to you is knowing there's going to be a downturn and knowing what's going to happen, nothing, because everything's going to be cheaper in a year or two. Now, if you're hell-bent on investing and you have to put some money to work, I understand that. Some people are. But otherwise, I would caution everybody to really think about that carefully, because we could talk about asset classes that might do better than others in a downturn. But this current timing, like I'm very stuck on the sidelines because I think we're going to see a recession unfold. I think there's a high probability of recession very soon. I mean, in the next 6 to 9 months.
Okay. And why nothing though, right? I'll predict what Jeremy's going to say. Is that because the likelihood of most asset values dropping or assets dropping in value during a recession that you might as well sit on your powder now and then leverage that powder to buy an asset or to invest in an asset 6 months, 9 months from now, because that same asset will be half priced or on sale or whatever it may be 6 to 9 months from now. Is that why? Or just because of the je ne sais quoi, not sure what's going to happen at all in a recession?
No, that's right. I think we're very close to being in a much better time to invest. And so part of it has to do with pricing. And part of it has to do with the typical recession effect. So the dominoes that fall when we have a recession would include, for the same property, you're going to have theoretically higher vacancy, right? Lower occupancy, which means less revenues, still expenses going up, lower NOI. So automatically the same multiple of that building is worth less. Okay, even at the same interest rate, same multiple and everything. But presumably, if we have a recession and it's a bad stock market reduction or crash, then liquidity is going to tighten on the lending side. And also investors are going to be scared and you'll have less liquidity on the equity side. What happens then? There's less money to invest. Prices have to adjust down for anyone who's selling because there's less demand on the buy side. So you actually have a compounded effect where the cap rates, the multiples change in the buyer's favor, along with the NOIs going down in the buyer's favor. And you have the compounded effect of a building being worth less than it was 12 months ago.